Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Stocks in the state sell off as doubts grow over a Fed rate cut next month. The Bureau of Labor Statistics warning it may take time to release the September and October jobs reports. And sticking with Washington, U.S. President Donald Trump is readying substantial tariff cuts designed to address high food prices, as well as a series of new trade deals in his latest affordability push. And sticking right here in the UK Chancellor of the Exchequer Rachel Reeves considering dropping plans to raise the headline rates of income tax and a slew of other levies in the autumn budget. It prompts questions of how she's going to make up for that revenue shortfall, Guy.
Good morning. Massive price action in the last 24 hours. Let's talk about what we're seeing this Friday morning. S&P futures down, but not by much. We're not buying the dip just yet. Euro Stoxx 50 futures down, but again, not much. Is the diversification trade going to work? Take a look at the Kospi overnight out of South Korea. Boy, has it taken the tech hit seriously. We're down by nearly 4% on that market. That's a big kind of signal at the moment right now to watch out for. Bitcoin is another one. Look at that. We're sub 100,000. 97,000 is the latest trade. Oil got hit yesterday, but it's bounced back. We're up by 1.2%. And Kriti was talking about what is happening with the UK situation. Look at the pound, down by 0.3%. How do you fill a £30 billion hole if you're not going to raise taxes? We'll talk about that in just a moment. The countdown to the opening trade, and it's going to be an interesting one today, starts right now. Friday morning, good morning. I was a little greedy there in terms of the things we're looking at this morning, but there's so much really fascinating price action at the moment. What are we seeing in the United States? What is going on? Is this just the logical rotation within the S&P? Bitcoin is fascinating. What we saw overnight in the Kospi, really interesting. There is a lot going on. Is this all just a reaction to the Fed, Kriti, or is there something more to it here? Is it just elevated prices and the Fed kind of as a combination, or is it elevated prices? People are getting nervous about that. What is the catalyst here, and does it have legs?
Well, I think the catalyst is easy because we saw it in the intraday price action in yesterday's trade. We did actively see that as we were getting comments from Kevin Hassett, getting clarity from the BLS on the timing, really re-emphasizing and backing up what we heard from the White House Press Secretary Caroline Leavitt just 24 hours ago in terms of the timing of some of these data releases. The answer is we don't know, and the markets, I think, were expecting some sort of clarity. So we know in the last 24 hours there was a catalyst. That being said, I think it did kind of mount on top of some of the other issues because we've had green on the screen for a couple of days now. There needed to be a little bit of the steam let out.
But is the catalyst related to the Fed? Because it strikes me as the catalyst is the Fed. The fact that the data, we're not going to get the data, which is going to leave maybe the Fed. It's going to make it easier for the Fed not to cut in December. That seems to be the kind of the line. So is the catalyst the fact that we're not going to get the data, or is the catalyst the fact that the Fed is sounding very hawkish and all the Fed speak is sounding more and more hawkish and we're pricing out December? That maybe is, to my mind, the catalyst for what we're watching here. Because if you've got high valuations, you're going to need some rate cuts to justify those multiples.
Except I feel like that consensus has been forming for a while. We heard it from Collins. We've heard it from some of the other messages.
But at some point it breaks, and at some point it becomes real. And stocks did that yesterday. We had this kind of slightly more positive view for the last week. We're coming into the shutdown, coming to the end of the shutdown. That's good news. But actually, in reality, it isn't. Yeah. And that was what we priced in yesterday.
Let me argue the opposite, the case of what you're saying here, which is, if you don't have data and if you're flying blind, and we've seen this before, we've seen Jay Powell do this before. We saw it in March of 2019 with the tariff story. The idea of an insurance rate cut has become his MO. If we don't have the data, does the absence of it increase the likelihood of a rate cut?
No, it decreases it by the looks of things.
That's what I'm saying, which is contrary to what my mind would immediately go to.
The Fed doesn't know what it's doing. It doesn't know whether it's inflation, doesn't know what the labour market's doing, doesn't have the data in order to make a decision. So you don't make a decision. So that seems totally logical.
That's what I think is the new bit, though, that the safer option is not making a decision as opposed to.
But that's what came out of the press conference. That's after the last Fed meeting. That's what he basically said. I've got a deeply divided Fed here. Some are worried about inflation. Some are worried about the labour market. We don't know. Therefore, we don't make a decision. He really called into question. He went out of his way before anyone even asked a question to make that point really clear. We're just getting reinforcement of that. But the market is finally having to kind of fess up and kind of believe that now, and it's dropped the December rate cut odds below 50%, and you see what happens with tech stocks, which were already kind of looking pretty elevated on the multiple front. you start to change the arithmetic around that, that's what you get. The other story, I think, which was fascinating from yesterday is this idea that we're going to be seeing changes to tariffs, an admission by the Trump administration that tariffs are causing concern for voters and are impacting prices. And you've seen that show up in the recent electoral outcomes that we've seen. And clearly the Republican Party, clearly the White House is now recognizing that. How does it change it? It changes it with tariffs. Yeah. So a confirmation, you could argue, from the administration that tariffs are inflationary. I wish Val was here.
Yeah, she'd go into that. I'll put my Val hat on, though. I think it's fascinating that he is saying this, because the affordability message has been one that he, one, campaigned on, but two, that what feels like his arch rival lately, the New York mayor-elect, Mamdani, has been speaking about bringing prices down, getting affordability. Not once has Donald Trump talked about food prices until now. Yeah. And I think this is fascinating because, and I won't sing the Mamdani song, even though it's stuck in my head at the moment yet again, but I think it's interesting that some of these trade deals that he's talking about, the number one export out of the United States is grains, it's barley, it's wheat, it's that kind of thing. To talk about trade deals that bring these things down, that brings you into Mexico, that brings you into India, that brings you into, I mean, if you're looking at chocolate, Switzerland, although we know that Swiss chocolate is a European. That's kind of a slightly more upper end thing.
Sure, but he's talking about bananas and this kind of stuff that's coming out of the Caribbean and coming. It's those kinds of things. So yeah, grains, that's one factor. But there's all kinds of other things we eat, and those are very expensive and have been going up because of tariffs. And he is basically... So what is the strategy now? What should we think about in terms of what's going to happen next? Clearly, the Trump administration a little rattled by the recent electoral outcome. It clearly recognises, possibly correctly, that lower-income cohorts are struggling, as a result of which, what does it need to do? Lower prices and maybe push money out to those cohorts to try and change the narrative ahead of the midterm. So is that what we're going to see just over the next 12 months?
That's absolutely, and I agree with you on all of this. I'm going to, again, argue just be the
You shouldn't be doing that, by the way. Don't agree with me.
Well, good, because I'm going to be the devil's advocate.
Bad point to start.
I'm going to be the devil's advocate for a moment here, because this is also not necessarily new. We've heard Donald Trump talk about trade deals with exemptions, with carve-outs, et cetera. Yeah. So the strategy isn't new. It's just what he's actually targeting that is new. And I think that really brings up to the point that the LatAm cohort, one, is going to help him politically with the midterms, but two, it's something that reinforces some of his foreign policy decisions he's making in Latin America. Again, these are all just early talks. We have to see what actually comes out of it. But the fact that it's the focus is key.
People are voting at the grocery store. That's what's happening here. They see their bills going higher, and it concerns them. And this is what he's now got to do to deliver a better outcome in the midterms. Let's talk about Rachel Reeves.
Speaking of affordability.
Yeah, precisely. Takes us nicely into that direction. You've got a $30 billion hole that you need to fill. How do you do it? Logical thing to do is pull some of the big levers when it comes to income tax, VAT. You can't do that. Because basically what is now becoming increasingly clear is within the party there is resistance to going back on the manifesto pledges. How on earth is she going to raise this kind of money without pulling some of those big levers is an open question now. And it looks like thresholds are going to be changed. So that's one area in terms of kind of where tax kicks in, income tax kicks in. That's going to be one. But how else she does it is an open question. The pound is clearly reacting to this. And you can see, and it'll be interesting to see how gilt's opened this morning as well. The concern is now, how is she going to do it? Are we going to have another one of these tweaking budgets where she basically tweaks a whole load of things and nobody's quite clear whether or not it's actually going to deliver the right outcome? Don't know. But basically the budget just became a lot more exciting in so many ways. Good job we got a special coming up.
We do have a special coming up the day after the budget to kind of see if she's convinced the market, to see how it's being digested. I'm still really, I mean, just from an international viewer's perspective, I'm still very confused and just equally puzzled of just how do you actually fill it? Because the UK economy has so many quirks that don't necessarily translate from other parts of the world.
No, we like to do things differently here. What have we got coming up on the show? Sri Kirchagovidan. I've just seen her. She's here. Aberdeen senior research economist is going to be joining us. We'll talk about all of this, just what we discussed. We're going to take it from a fixed income and an FX point of view with Laurent Van Billon, Allspring's global investments head of rates and FX. Patrick Armstrong, Plurimi, is going to be here a little bit later on. How's he positioning around this big tech trade? It's interesting. He's got some really interesting shorts. We'll talk about those with Patrick a little bit later on. Later on the show, we've got the CEO of Vinted coming on. I can't wait for this. They're growing at 25%. Okay, revenue 25% up year on year. We're going to talk about that. And Anders Melstrom is the Swiss RE CFO. How much private credits, private equity, private is in that company's portfolio? I want to answer the get an answer to that question.
Yeah, the wrap-up and the overlap between the private markets and the insurers are starting to cause a few jitters on both sides of the Atlantic. In the meantime, let's talk about some of the data that's coming up at 10 a.m. UK time. A slew of info coming from the Euro area. We've got economic data, GDP, employment, trade, you name it. It's coming out at 10 a.m. UK time. Then, of course, the ECB's Elderson is going to be speaking just 30 minutes later. I think we're all waiting, though, for what the Fed is thinking. We were kind of talking about this at the start of the show when it comes to these jobs numbers, the hawkishness, the dovishness, the split. We'll see. We have Jeff Schmidt, we have Logan, we have President Raphael Bostic, who's recently announced he's actually taking a step back.
Yeah, he's going to resign. Well, yeah, he's coming to the end of his day. He's like, thank you very much. Moving on.
He's had it.
Yeah. Which opens up questions as well as to who's going to be kind of sitting on the Fed. But we'll come back to that a little bit later. What else do you need to know this Friday morning? There's a lot going on. China's economic activity cooling more than expected at the start of the fourth quarter. Beijing reported an unprecedented slump in fixed income investment, which shrank by 1.7% in the first 10 months of 2025, while the National Bureau of Statistics says industrial production saw its smallest gain of the year. 4.9% was that number. The Ukrainian capital has come under attack by Russian drones and missiles overnight. The mayor of Kyiv has described it as a massive enemy attack, quote, and says at least 25 people have been wounded. Meanwhile, Ukraine has carried out major drone attacks causing damage to a Russian oil depot on the Black Sea. That news sending oil prices higher this morning. And German lawmakers have approved several big-ticket military procurement deals in total worth 3.9 billion euros. This as part of Chancellor Friedrich Merz's plans to massively ramp up the country's armed forces. The list of defence contracts includes 20 light combat helicopters from Airbus. It also covers 100,000 night vision devices from Hensoldt and Theon under contract. That contract worth roughly 1 billion euros, Kriti.
Coming up on the program, we're going to check on Swiss luxury powerhouse Richemont, as it's called higher on TradeGate after first half sales beat estimates this morning. Plus, sticking with the corporate space, Repsol considering a reverse merger of its upstream unit with potential partners, including U.S. energy producer APA, formerly known as Apache. We'll check on those shares at the European Open. Big move in the States in the Apache story. Up next, though, right back to the stock market. It's this time from a macro lens. Worries about next month's Fed meeting. How big should those worries be, or is it priced in the market? If any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
We haven't seen a thing that is concerning us. The consumer in the States is being fiscally responsible. Companies have been building up some more cash, either for a rainy day if it proves necessary, but most of them for investment. And they're acting from a position of strength. We'll keep an eye on the labour market. We'll keep an eye on some of the areas of mid-tier players in private credit and the like. But as far as we're concerned, that second, third order effects, the bank's not seeing anything that we're worried about.
Bank's not seeing anything we're worried about. We'll wait and watch that picture very carefully. Citi CEO Jane Fraser speaking exclusively with Stephen Engel on the sidelines of the Citi China conference in Shanghai. She's not worried. The Fed's not worried, but it's not in a mood to do anything at the moment. It doesn't know what it wants to do, and that's certainly been the message we've got from Powell and plenty of other people as well.
But when you have a let's just do the doomsday scenario. When you have a recession around your corner or a GFC or whatever, no one realizes it in the moment that it's happening. You realize it in retrospect, right? And I don't think we're sensing the same sort of panic we've seen in 01 and in 06 or 07 or 09.
From who?
Anyone. Right?
There's a few people panicking out there. There's a few people nervous about what is happening.
Nervous, but not panicking. We're not like.
So why does the Fed need to cut?
It's a good question.
OK, we'll get back to that in just a moment. The Fed is probably the biggest catalyst for some of the repricing we've seen over the last 24 hours. Big moves in stocks we've seen coming through. You're certainly now seeing maybe the Fed being priced at less than 50 basis points in terms of the expectation around the possibility of a rate cut come December. Take a listen to some of the Fed speak we've had over the last few hours.
We have inflation that's still too high, running at about 3%. Some sectors of the U.S. economy look like they're doing great. Some sectors of the labor market look like they're under pressure. How do we make sense of these mixed signals?
We need to proceed and tread with caution, because I think there's limited room for further easing without monetary policy becoming overly accommodative.
To my mind, it's premature to say definitely no cut or definitely a cut. What's more important is to say the direction of change in policy is looking like it be towards neutral.
I think we need to remain somewhat restrictive to continue putting pressure to bring inflation down towards our target.
Fed speakers over in the States. Let's get a little bit more analysis here. Sri Kochugovindan, senior research economist over Aberdeen Investments, joins us around the table. Sri, we just heard from a series of Fed speakers who are starting to sound increasingly hawkish. They're talking about inflation. They're talking about hold. They're using the words restrictive over and over again. We don't have a data set. Guy and I have been basically for the last 18 minutes of the show discussing should the next move be a cut or a hold. What do you think?
So my view at the Aberdeen, we're expecting a cut. And here's why. We've had a data fog. But within this sort of US government shutdown, we've seen a number of different impacts of that. We've seen SNAP payments freeze. We've seen furloughed workers. They will get their back pay, but obviously there's going to be a hit in Q4 to GDP. So we're expecting that hit to be around 1 to 1.5% annualized basis. That will rebound in Q1. But not all of it will return. You know, there'll be some permanent impact in terms of cancelled trips or cancelled services. So overall, what we're seeing in terms of the near-term growth outlook, that's going to be weaker. Labour market data, the little that we've had from the private sector, that's been steadily weakening. So I think overall, the balance, given recent comments, yes, inflation is sticky. Yes, there are potential risks in terms of tariff, and we're looking at food price tariffs being cut.
Yep.
But I think overall the balance would be towards insurance cuts and a cut in December. So I know it's on the knife edge, and I think the speeches from here on will be really important.
Yep.
Because we still have a data fog.
Before Kriti jumps in, what do you make of the speeches we just heard?
Yes, exactly. So what we've heard just now was really focused on, yes, that mix in views in terms of inflation, in terms of being too restrictive, being cautious about going too easy on policy. But the labour market data is weakening. And I think for now, it makes sense to cut in December and then hold and then see. So what we do expect is a pause going in, potentially into June of next year. It is a very close call, but for now, it seems that a cut seems reasonable. Obviously, the speeches will steer us from here in the coming weeks.
So the argument, though, against a cut, so the argument for a hold is simply that by a cut, you're risking kind of exacerbating the effects of inflation.
Yeah.
The labor market, yes, it's slowing down, but we're not seeing layoffs en masse just yet. We're not at that point. We're seeing a slowdown in hiring, but that's a function of uncertainty. Does the labor market slowdown outweigh the risk of exacerbating inflation?
I think it depends on obviously we don't know we can't necessarily rely on the data that's going to come out, and that's something we can talk about. But I think what was interesting in the minutes that are released next week, that will be very interesting. But there the focus was on, yes, there's inflation, but this is likely to be temporary impact of tariffs. So this signal that they gave in the last meeting was they would look through it. The signal was very strong in the last meeting. Yes, it's shifting now, but why is it shifting? We don't actually have any real information to shift to base that on. That's where I'm sort of thinking, well, why are we shifting our tone? Because we still don't have any clarity.
How long does the fog last? How long is the room going to be foggy for Powell?
Well into next year. Because what we see is we've already heard that we'll see the October 3rd data will be published, I think, next week, potentially. So some of this data has been collected, but some of it is going to be missing. So if we think about payrolls and jolts, that's quite easy because you have data submissions online and emails. But the unemployment rate obviously is not going to be released. That's already been we've already been told that. Anything with household surveys, with phone surveys, that will be missing. But also in terms of inflation, the sort of collection of baskets, some of it's automated, but some of it is done by the government workers. So that will need to be, what will they do? Will they impute it, or will we just not publish it? There is a big question mark. If it's released, how much can we actually rely on this inflation data? So I think inflation specifically will be a bit confusing for another couple of months.
Rachel Reeves has got this really big hole, 30 billion. It's enormous. How do you fill that up? I don't know. The pound is clearly nervous this morning. I'm waiting to see what gilts do. Elsewhere in Europe, yields are higher this morning. like what happens with the yields this morning on the back of this FT story that everybody's picked up on, the fact that she's not going to raise income tax.
Well, the game plan across Europe has been raise income tax, raise corporate tax, et cetera.
Yeah.
But you've also seen people very reactive to it. People are actively thinking about leaving London in troves to Miami, to Dubai, to Singapore, you name it, in response to this. So maybe that's what she's picking up on?
Well, I think she's talking about maybe getting rid of the exit tax, because that's been floated over the last few days as well, and that looks like it could be on the chopping block too. So maybe that goes. So that, to your point about kind of what is happening with the higher end of the income spectrum, but it's further down that I think the real challenge is ultimately going to be. Shri, if she doesn't hike income tax, how does she fill the hole, and what do you think the gilt market's going to do here?
I think it was very interesting to see the gilt market reaction after that unusual or extraordinary speech that was, what was last Tuesday, was it?
Feels like a long time ago, yeah.
Feels like a long time ago. So that tells us a lot. The gilt market wants to see this fiscal gap filled. And tweaking at the edges with sin taxes but they're tweaks, aren't they? They're tweaks. They're not meaningfully going to fill this gap because you need to get that headroom filled. You don't want to be sitting on a £9.9 billion headroom. It's not enough. It can be wiped out very, very quickly. And I think the gilt market response this morning will be very interesting for sure. I think the attitude is, let's just fill this gap now, raise income taxes, freeze those income tax thresholds, make more meaningful policy measures that can actually bring in some revenue, because it's very difficult for them to cut spending, welfare spending, given the pressure from the left. Obviously, there'll be pressure from other parts of they're probably concerned about by-elections next year. It's a very difficult position to be in. But
that's what Mark Dowding was telling us the other day from RBC Blue Bay. He's like, they could raise taxes, but actually what the gilt market really wants to see is cuts. Spending cuts.
Seeing spending cuts, but also you've seen the market, Shri, respond to some of these political jitters, which I thought was interesting.
Yes,
you saw it in you saw it in pound weakness. You saw these, rumored or alleged kind of coups on Starmer from Streeting and others. Do the politics matter here?
I think it does. I think at the moment these are all rumours. There's nothing concrete just yet. I think the market would be very disturbed if we have a change of leadership or change of Chancellor. We saw that just a few months ago when there were rumours around Chancellor Reeves's position. The gilt market sold off quite quickly, and that was a clear signal that we want someone who's going to be, as she said, ironclad about the fiscal rules. The fiscal rules are very important in all of this.
What if she's not ironclad? Because
I think that would be very dangerous in terms of how the debt burden will suddenly increase if gilt yields go up. And I think the fiscal rules can't be touched. So where do you make the manoeuvre? It will have to be in the manifesto pledges. Otherwise, if those pledges aren't broken, it's going to be very difficult to pull together these tweets to fill that hole.
The fear here as well is that if you end up getting rid of Starmer and Reeves, that you end up with a much more left-leaning Labour Party.
That is the fear.
And the gilt market's terrified of that.
We are going to continue that conversation throughout the show, and of course in the lead-up to the autumn budget. Shri Kochigovindan, Senior Research Economist over Aberdeen Investments, joining us around the table. We did a little bit of a transatlantic tour there, talking about the United States, talking about the UK. The issues are the same. No one can afford anything, it seems, when it comes to government spending. Is the bond market going to react with more force coming towards the end of the year? We're going to ask our next guest that. More markets chat with Lauren Van Beon from Allspring Global Investments. She's a senior portfolio manager there. More coming up. This is Bloomberg.
Let's take a look at what's happening with the markets with 30 minutes to the start of cash trading here in Europe. Big move lower yesterday, so you just kind of see everything in the context of that. S&P down hard yesterday, Nasdaq down even harder stateside. So at the moment, what you've got is a 0.5% move, moving lower when it comes to Euro Stock 50 futures this morning. FTSE's down by around 0.7%. You're not buying the dip of yesterday into this morning in S&P futures, so just bear that in mind. Crypto's getting crushed. It's down again and again pretty hard. The bond market, keep an eye on what is happening with bonds. European bonds are just opening. Yields are moving higher. That is something you need to bear in mind as well. We're going to wait for gilts in around 29 minutes as well. The pound is under significant pressure. There is a lot going on, and there is plenty to catch Kriti's eye.
plenty to catch my eye. Let's marry the two things you just talked about, because yesterday, to your point, the stock sell-off in the States down about 1.7% at the close. Now, it followed a couple of days of strength, which I think is what this chart is showing. I pulled a Guy Johnson here, a 6-day chart of the S&P 500, so I'm going to kind of walk you through the last 6 days. You kind of basically seen that we've done a little bit of a round trip when it comes to the equity market, but this is crucial here because we are now back at levels that we saw last week. So we've had 3 days of gains. Some of the momentum needed to come out of the stock market. We saw a big hit. The catalyst seemed to be the conversation around the BLS and, of course, whether or not the Fed would hold or cut. But then it got me thinking, how does the stock market react to the bond market? Which brings me to this chart. The correlation, the 40-day correlation between the S&P 500 and the U.S. 10-year. It's a pretty basic chart, but I think it's important to talk about the narrative that comes around it. So I'm just going to walk you through the narrative that shifts that you have seen. This red and green that you're seeing on the bottom, that's the correlation, the stock market on top, since the start of the year. So since the start of the year, we go all the way back to the inauguration of Donald Trump. We see a big inverse correlation between bonds and stocks. That conversation continues into Liberation Day. The idea that if you were worried about inflationary pressures, if you were worried about a 10-year that hits 5%, does that ultimately smack some of those growth stocks down because of the higher yield and sensitivity that you see on those round levels? 5%, 4.5%, 4%. That kind of is where we go down on the spectrum. And that narrative has gone back and forth. Fast forward to right now, where we are starting to see the yield and the stock market move in momentum. That's what this green on the screen is telling you. Basically, if the yield goes higher, the stock market goes higher. And, Guy, we saw this happen back, again, I'm going to bring it back in April, when the Sell America trade was back on. So the question I'm going to pose to you is the correlation, the growing correlation between stocks and bonds in the States, some sort of indication that international investors are more wary of the Sell America trade coming back?
Maybe. Let's try and get some answers to that question. Lauren Van Bion, Senior Portfolio Manager at Allsprings Global Investments, sitting around the table with us now. Kriti raises lots of questions. Let's deal with some of them. Are we going back to 5 on a US 10-year? We're at 4.125 this morning. Are we going up or down?
Short term, it does feel like we're heading higher, doesn't it?
Okay.
Yeah, we know that the Fed is going to be very data dependent going into December. I think what's not changing so far is the terminal rate that we're seeing the Fed at.
Okay.
But there is so much disagreement about the pace that gets us there.
And what do you think?
I think on balance they hold this in December. Okay. But it's going to be...
January? We're on to January now.
On to January now. I could see them... I think if they hold in December, I think we probably go in January or February.
Right, so we're not done.
If we're not done.
Right.
We're not done. The way that labour market is evolving, that gap between the highest percentile and kind of everyone else, that does say to me there is some stress underlying there. Although I really do worry about that gap between market-based and sort of consumer-based inflation expectations.
Because the consumer sees more inflation.
Exactly. So, but again, maybe that's telling us more about the pace of cuts than the actual terminal rate. I think the US is still in a restrictive mode, so they've got some space to cut. But it is probably running out.
Space to cut, how much of the financial conditions that we're seeing supports the case to hold, i.e. you're seeing a stock market that's still rallying, yesterday excluded, but a stock market that's hitting record high after record high. Yeah. You are seeing a range-bound bond market for now, oil, dollar, et cetera. How much of the case for a hold actually lies in financial conditions?
I think it's a good point. And what we're seeing out of earnings have been really strong, right? If you look at the demand we're seeing at for corporate issuance, it's been incredible. And at Allspring, we think securitized sector, perhaps your sort of higher rated sort of corporate bonds are still a great buy. So I think the financial conditions are probably not where the stress or that push for lower rates is. But I think on a relative basis, the US is still very much a sort of higher interest rate environment right now, right?
That's fascinating because we're still talking about a higher interest rate environment and then this gigantic amount of issuance that we're seeing. You and I talked about this earlier this week and I think last week as well, which is if you're starting to see corporates come to market, including the Oracles, the mega cap tech names of the world, are they calling the peak?
Oracle stock got smashed yesterday.
Yeah.
And you wonder whether the fact that Oracle is taking on so much debt to deliver the AI story is AI. What do we think about AI debt? In this kind of environment? There's all kinds of debates happening around what happens with depreciation of chips and kind of whether or not actually we've got the balance right in terms of how long you're putting that onto the books for. Special purpose vehicle, all kinds of things are happening here that kind of ring a few alarm bells at the back of the head. But at the moment, demand's quite big. But if it shifts, then you've got quite a kind of a series of dominoes that could come under pressure if that debt doesn't get bought.
Well, it brings that back to the question that Lauren was talking about here, which is if you start to see those dominoes fall, and there's a big question here of this kind of exodus from sovereign funds into corporate credit that ultimately creates a glut in the corporate credit market. Is that cause to worry over at the Federal Reserve? If you see a stock market correction, a glut in corporate credit, these dominoes could fall fairly quickly. In that environment, do you cut?
I think the Fed, obviously, like paramount is that financial stability, right? Inflation, labour market, absolutely. But those don't happen unless there is that financial stability. So I mean, that's going to be their loads.
Isn't that a reason to keep rates where they are?
Yeah.
So that you have that firepower, you have that dry powder ready to go when you ultimately need it. People talk about insurance cuts, but in some ways, you're also sort of giving away what you may need later.
But what's the lag on that then? A traditional lag is 18 months.
I think that's been shown to be a lot. There is evidence to say that that's shorter now.
It feels much shorter now than it was in the past.
How much shorter are we talking?
I mean, 4 to 5 months, maybe 6 months.
Wow.
Maybe slightly longer. Let's exaggerate. That is very short, isn't it?
That's speedy for Washington.
Maybe it is sort of like 2 to 3 quarters, though, but rather that sort of full 18 months that we had before.
Yeah.
What do you make of the pound move this morning?
Fascinating, isn't it? I mean, the news overnight that Rachel Reeves hasn't yet decided on what's going to be happening in this budget, and there's all these various options. But I think I'm seeing a lot saying this is worries about the fiscal side and that long-term stability, and obviously that's part of it. But I think this is also telling us a lot more that the market is really worrying about Rachel Reeves' position itself.
Yeah.
Because what this says to me, if we're this close to the budget and there's this much disagreement, what we're saying here is that the Labour Party does not have a consensus, and she's struggling to sell her preferred options to that wider party, and that's a real concern.
So we were talking about this just a moment ago. Is the fear that she gets replaced by somebody, or that Starmer and Reeves get replaced by somebody that is harder left?
Absolutely, right.
So that's what's being priced this morning, you think?
Yeah. I mean, you think the margin of victory at the last election, the majority they've got, the way that polls are deteriorating for them, in my opinion, Labour should not be thinking about, stability is key here, and kind of running with the horses you've chosen. But all the briefing around potential leadership challenges, et cetera, is what's unsettling the pound.
Can you just give us that doomsday domino effect for the folks that are not watching UK politics as closely? So let's explore the hypothetical here. Rachel Reeves delivers this budget. Yeah. People aren't a fan. She doesn't raise the income tax.
By people, you mean the gilt market or the electorate?
The
Labour Party?
Name your folks. I was going to say the electorate, but sure, let's talk about investors as well. I've meant the electorate. If you do get to this point where you have a different set of characters, Starmer and Reeves, you do have a move towards the hard left. What's that do to the gilt market?
I mean, it suggests higher gilt yields, doesn't it?
Is it that simple?
It is that simple, I feel. And we've had the UK is still suffering from the sort of the trust meltdown. How many years ago now? Right, you can still see that kind of worry in the gilt market.
Even if you have, again, forgive me, I'm not as versed in the UK political scene as perhaps Guy is. But talk to us a little bit about, even if you do have a longer, higher income tax increases in the situation of a harder left, and they're able to close the fiscal deficit. This is also very, like I said, hypothetical. Isn't that a better thing for the gilt market?
I think it depends in terms of confidence, right? And that longer term, what does it do to longer term growth potential? The UK is a very open economy. Its financial sector punches far above its weight in terms of real economy. And so anything that disrupts that sort of the UK's place in that sort of global financial economy is a problem.
We'll leave it there. It is a problem. Lauren, thank you very much indeed. Lauren Van Biljon, Senior Portfolio Manager at Allspring Global Investments. We've got the run to the budget is fascinating now.
A dark note.
Coming up next, we're going to turn our attention back to what is happening with the corporate story. Richemont sales climbing on better than expected demand from the US and, interestingly, China. We're going to talk about that and all your other stocks that you need to be watching. I want to flag something else. We're going to have a conversation with Santander's Executive Chair, Anna Botin. She has been speaking with David Weston on Wall Street Week. Her view on what is limiting Europe's growth potential looks like this.
Excess regulation, excess taxation, actually is a tax on the economy and growth. At some point, people don't invest. And so this is the balance we need to find. And Europe is getting further apart from the United States, not coming closer.
We're about 16 minutes away from the opening trade. Take a look at this. Futures are starting to sell off just a little bit more than maybe we saw. The big hitter, though, is the FTSE 100, down about 0.9%, reacting very quickly to the comments perhaps that we heard from the UK, the reports of where the UK might go.
So that's interesting, in as much as you would argue that a cheaper pound should mechanically make the FTSE go higher, and it's not this morning.
There seems to be a regional trade afloat. We were talking about the Sell America trade later. Maybe the Sell UK trade is very much on today. In the meantime, let's go back to that Sell America trade, because here's something we haven't factored in yet. U.S. President Donald Trump is readying substantial tariff cuts designed to address high food prices. He's also set to unveil trade deals with Latin American countries to reduce tariffs and barriers on common grocery items. The push, of course, comes after key electoral victories for Democrats last week in state and local races. For more, I'm joined by Bloomberg's news desk editor Balazs Pence, who's, of course, been watching us from the other side of the world. Balazs, just walk us through these potential tariff cuts. How realistic are they?
Yeah, Kriti, so it looks like what we're seeing is a series of measures that the White House is considering to lower some of those food prices that have been hurting Americans. Specifically, the announcement yesterday was that they signed some framework agreements with 4 Latin American countries, namely Argentina, Guatemala, Ecuador, and El Salvador. And these include lower tariffs for items like bananas, coffee, and beef. And we also heard from the White House that they are considering similar steps with other countries. Some of the reporting indicates that these could be carve-outs from existing trade agreements, those country-by-country deals that we have spent so much time talking about that the White House signed. So there is a recognition that food prices are painful for Americans, and the White House is looking at tariffs as a way to address those issues.
Fascinating, isn't it? Apparently tariffs aren't inflationary unless you actually go to the grocery store. Balazs, what does this tell us about the priorities going towards kind of the midterms next year? What does it tell us about how the White House is rethinking its proposals post the recent electoral losses that we also had in the United States for the GOP?
That's really interesting, Guy, isn't it? Because the White House, Trump, the Republicans were selling the end of the shutdown as this big political victory. Yet, if you think back to the signing ceremony of the bill that ended the shutdown, the president already at that moment was talking about affordability, the cost of living, those kitchen table issues that the Democrats did so well on in the off-year election. So clearly this is an area where the White House is sensing some political vulnerability, and this is something that they are trying to address. So food prices seem like are going to be a hot topic going into the midterms next year, and that's something that the White House is trying to address, even if that comes at the cost of one of the president's signature policies, tariffs.
Well, thank you very much indeed. Yeah, it's going to be the politics. It's going to be amazing to watch. Balazs Pence joining us on what we're seeing in US politics. Let's talk about how this is all feeding through into the market. Big move yesterday, huge move yesterday. Looks like the market's increasingly pricing out a December cut from the Fed. That's rippling through into other assets, particularly highly valued tech stocks. What happens next is the key question. Mark Cudmore joins us now, Markets Live executive editor. Mark, is this just a wobble, or is this something more significant?
I think this is just a wobble, but it's a wobble that I expect to continue for another couple of weeks. We've talked about in the show over the last week or so that the pullback that started at the end of October did not seem like it's exhausted yet. And, you know, really, we've had no real drawdowns over the past 6 months. We're due a little bit more of a clean out. And I expect this to go a bit deeper over the next week or two. We are seeing winners get targeted here. I don't really think that the move in Fed rate cuts was that, much of a difference. Went from 60% to 50% of a December cut. That doesn't really matter much. What really happened here is people are taking money off the table. They're getting nervous about the retail sector because of the squeeze in the consumer and the wealth effect, because whilst we're seeing the digital asset sector get completely destroyed, that's leading losses and that's weighing on the broader tech sector, those retail favorites. I expect that to play out a little bit more next week. It's going to be helped by NVIDIA earnings story, which will be probably an incredibly positive earnings, but we've seen over the last 15 months that whenever we get NVIDIA earnings, the NVIDIA stock almost always sells off after it. It's kind of take profit moment. So that'll feed that narrative of taking some money off the table, a little bit more rotation, but this is not the bursting of the bubble. We are in an AI bubble. It'll burst horrendously one day, but I think the big bursting is 2026. This is just a little bit of volatility and a bit more to go.
Mark, I want to circle back to the comments you made at the very beginning, which is kind of the Fed cut wobbles that may or may not have moved this market. The dollar is stronger today, and the bond market isn't moving much. 412 on the U.S. 10-year this morning. The dollar stronger seems to be more of a reaction to what's happening in the pound and weakness on this side of the Atlantic. Can you just walk us through your thoughts on two very different countries that have two massive fiscal deficit issues? What does cable do in the face of those?
Yeah, so you're right. Dollar's a little bit stronger today, but remember, it was quite a bit weaker yesterday. Yesterday was actually a brief sell America day again, where we saw treasuries weaken, we saw the dollar weaken, and we saw U.S. stocks weaken. So I think, you know, the strength, the little bit of strength we're seeing today is just in that context. Sterling we're also in a sell UK moment as well. There's a real negativity about there, and everything in the UK news flow is being seen through that lens. And I do expect sterling to have more downside. And it also ties into the narrative that winners are suffering. UK stocks have had a good year. The pound has had a pretty good year. People are taking money off the table, and they're very negative about the UK at the moment. And that's the backdrop with which we're going into next week's CPI report, is that people want to see a Bank of England rate cut in December because they are very negative on the UK.
Mark, just very briefly, crypto, Bitcoin, where are we going?
As you know, Guy, I've been saying for a few weeks, I think we have a lot more downside, and that's the lead in risk sentiment. And that's why I think ultimately this correction has a bit more to go. That said, I have to say the price action's incredibly resilient. Bitcoin's broken to a 6-month low, but there's no collapse there. And in fact, the altcoins are kind of bouncing back a bit this morning. So I think it's going to be a continued grind. We're seeing the digital asset treasury companies led by MicroStrategy get completely destroyed. And that is a narrative that still has more to play out.
All right, Mark Cudmore, our Markets Live executive editor, we thank you so much. More analysis from Mark and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with Richemont today, which could be moving higher after reporting very strong sales, and that was thanks to solid demand in the US and China. And so that echoes what we heard from Burberry yesterday and some of those other luxury names throughout that earnings season about this rebound in the Chinese market. And we could see Richemont shares moving higher this morning on the back of those strong results. They've already been outperforming LVMH and Hermes and could see that additional lift. Richemont is also the last big luxury company to be reporting this earnings season, and it seems to be really confirming this narrative of a recovery being underway for the luxury sector. So we could see some movement there this morning. Moving on to the video game company Ubisoft, which could be softer after calling off its earnings release the very same day that it was due. So that is quite an unusual move, and that could be fueling speculation that something has gone wrong after a series of setbacks for that company, and that could put further pressure on the shares that are already down of almost 50%. Some are a little bit more positive. Analysts at TD Cowen said that it could actually be quite very positive, so we'll see. But that lack of clarity probably will lead to some weakness in those shares this morning. And finally, let's end with Italian banks after some new ratings at KBW. So we have got Intesa and Banco BPM being cut, and Mediobanca and Montepaschi being raised, being upgraded at KBW. As we can see, those are companies that have been doing very well over the last year. And we'll see how those downgrades and upgrades feed through and what is reflected in those shares this morning.
Chloe, thank you very much indeed. It's going to be a busy morning on the single stock story. We've got lots going on. There's lots of deals in the energy space as well, a lot of earnings that I think NL caught my eye this morning in terms of what we're going to see there. There's also a kind of AI mention within the NL numbers as well. Yeah. We should see how the market reacts to that.
We're already seeing some of the tech names indicated higher, at least in the pre-market, or actually the trade gate pricing. We don't have pre-market here, but the trade gate pricing you are seeing, it would be nice, make our jobs a lot easier. But the ASMLs of the world that I feel like weren't getting as much love this week as some of their kind of U.S. tech counterparts.
No, but look at what happened with the U.S. tech counterparts yesterday. Yeah. And Oracle had a really tough day yesterday. But as Mark was saying, we're basically moving in towards the NVIDIA numbers next week. Yeah. What is that going to tell us, and what ripple effects is that going to have in terms of this market as well? That feels like the next big kind of catalyst event that we are watching out for in terms of this market. You've also got the Repsol story, which is interesting as well. You were mentioning that. Is it not Apache anymore, is it? It's
APA. They rebranded. I think letters are the new cool thing to do now. But it was previously Apache, one of the massive Permian drillers in the States, very domestically focused. So this is a really interesting kind of story that's to come about. We should also say there's reports, and this might not necessarily reflect in the European Open, but reports around Lukoil assets and the fact that Carlyle is actually potentially considering some of the licenses to take over those assets in the state. So there is M&A in that space.
What is interesting is the oil is higher this morning.
Yeah.
And there's some connection being drawn to what is happening with Ukraine hitting some of the Russian oil assets.
Yeah.
Is that what's moving oil this morning? I don't know. But oil got hit quite hard yesterday. But it's interesting that that's one of the assets that's come back into this session. Anyway, coming up, it's the opening trade. Futures are pointing fairly negatively at the moment, in fact, getting worse. So we'll work our way towards that open. 5 minutes to go. Plenty of things that we need to be discussing. Crypto, what is going on there? What is happening in terms of the overall narrative? Corporate earnings have dominated this week, but it does feel like increasingly likely that the session that we're about to see maybe is more of a top-down narrative sort of story. People rotating money out of some of the big tech stocks. Is that going to be something that helps Europe in some ways? Are we going to see the diversification trade maybe kicking in and working for Europe? Does it get hit less hard? What is the beta between all of these various big markets? We're going to watch out for that one. Plus, UK assets. Could be a tough morning. Anyway, the opening trade is coming up next. This is Bloomberg. Friday morning, good morning. You're not there yet. Friday's session's going to be really interesting, I think, to watch in light of what we saw yesterday over in the United States. Big rollover in tech. That obviously had a big implication for the indexes. You certainly saw it in the S&P, but you saw it in the NASDAQ. You've seen it overnight in the Kospi as well. Take a look at what's happening with Bitcoin. This is what the S&P looked like yesterday. We rolled over. We finished near session lows. And I think just in terms of the narrative around the price action, just finishing near session lows is something you want to pay attention to. That's where we went out in Europe, so we've got that to price in. That's some of the downside you've got to factor into your thinking first thing this morning when it comes to this. Euro Stoxx 50 down by 0.5%. FTSE futures are down a little bit more, which is interesting because the pound's down. So you would have thought mechanically, actually, FTSE would be a little bit benefiting from that, but it's not. There's a lot of concern around the fiscal position, political situation here in the UK. S&P futures are still down as well, which is interesting. So you're not seeing at the moment this morning, this Friday, and it could change as we start to get maybe US traders getting to their desks. That's shifting, but at the moment, the dip buying is not happening, which is interesting in itself as well. Kriti, single stocks, what are we watching?
Well, we'll start with the luxury space. Richemont sales climbing, stronger demand from the States, from China. Looks like those numbers are going to show up. We've seen a little bit of a boom in the luxury space in yesterday's trade as well. Burberry's numbers seem to have bled into the broader sector. I wonder if Richemont will do the same. We've got a bit of an energy M&A story. Repsol, of course, very much in focus. But Siemens Energy, guys, seems to take the cake when it comes to what the trade gate pricing is indicating. That being said, it's coming under a fairly negative, broadly negative market. So I'm curious how much of this actually stands out.
Okay, let's talk about kind of what we are going to see in this session. So you're expecting a negative start. How negative, which stocks, which sectors are going to move here, I think is going to be really interesting in terms of what it tells us about the market narrative. Got a reaction to the States. Got to think about what happens next as well. Is this all about the Fed or is there something more in the mix as well? Okay, here we go. FTSE 100 expected to be down, let's call it circa 0.8%. Is it going to be a little bit more? Is it going to be a little bit less? You're going to see some of the big names opening up this morning. What is interesting is that oil prices are back up this morning, so maybe that is a more positive story for the likes of Shell and BP. So maybe that limits maybe some of the damage you're going to see in the FTSE 100 this morning. But the FTSE 100 is dropping towards that kind of circa 0.8% move to the downside, which is what roughly we are expecting this morning. I think roughly what we are seeing. So futures reasonably accurate there. So yeah, we're down a little bit more now. The CAC is opening fairly quickly. We're down by 0.6%. Stock 600 down by 0.7%. The IBEX is getting hit harder. It's down by 1.23% this morning. We'll look for some single stocks there. I think it's going to take a while to get the DAX and the SMI open first thing this morning. But a measured reaction, maybe you could argue, in European indexes this morning to what we saw in terms of the big losses we saw pretty yesterday stateside.
Absolutely. We're still seeing some of this market kind of shake out as we get these early reads on. But right off the bat, to your point on the tech space, you are seeing some weakness. That seems to be what's driving down this index. You see it on your screen here from a sector basis, red across the screen. But the kind of pain points very concentrated in the FTSE 100, although I would say the CAC, the Stoxx Europe 600, not far off. That divergence we saw in the futures picture certainly not showing up here. Let's get to some of the single names, though, that we're starting to see here, because ASML, to your point, is moving to the downside. We're seeing some of the British banks really take a hit. Lloyds, Barclays, and kind of a couple of other UK names as well. So that Sell UK trade that we were talking about leading into the open, starting to permeate here as we're getting some of the early reads.
So you are getting a huge move in gilts this morning, okay? Massive move in gilts. We're up by 11 basis points. Just for reference, you've got the Bund is up by 1.9. So we are up 11 on gilts this morning. That is why you are seeing what you are getting in the UK banks this morning, which obviously have some sort of relationship with that gilt market. But that is a very big move this morning. We're now up to 4.547 on a UK 10-year. So a huge sell-off coming through into UK gilts surrounding the concern off the FT report this morning that we are getting potentially a ripping up of what was expected by Rachel Reeves, the Chancellor of the Exchequer, that she is going to be raising income tax. That looks like it is going out of the window for political purposes. The question is, what fills the gap that she has to fill? And what is that going to do in terms of her political future as well, and Keir Starmer's? Big reaction, I would argue, in the gilt market this morning, coming off the back of that first thing this morning.
Absolutely. You mentioned the gilt space. We certainly saw it in the stock market as well. I'm just very quickly looking up where we are starting to see some of the pain points, at least in the equity index. It's not just the FTSE 100. You want to start looking at the small caps as well. If you go down that range, the FTSE 250, for example, down about 1.2%. You're seeing more pain in the FTSE 350 as well. The smaller, more domestic-focused stocks you go to, the bigger the pain point. Let's get a little bit more analysis here perhaps this morning. Patrick Armstrong, Chief Investment Officer over at Plurimi Wealth, joins us around the table. Patrick, we were all ready to get you talking about the tech story. But we've got to talk about the UK now, given that we are seeing this kind of reaction. The stories aren't all that different from what you're seeing over in the States in terms of fiscal issues, taxation, tariff risks, geopolitics, etc. What do you do with the UK?
Well, it's completely similar situations. The UK's debt and deficit, very similar to the US's debt and deficit, both untenable. US is hoping for the best, hoping to grow their way into their debt. The UK is considering tax increases and then reconsidering tax increases. And I think the market's reacting to the uncertainty about what kind of tax increases. And the Laffer curve that we talked a lot about in the 80s, the other way as well. When you increase taxes, do you reduce your tax base? And there's a negative impact from that. So a flight of the high net worth out of this country. It's something that's very difficult to do. I don't think either strategy is going to work. The US isn't going to grow enough to manage their debt, and the UK won't be able to tax enough to manage their debt.
Is the fear in the UK now, though, that Rachel Reeves and Keir Starmer go and ultimately get replaced by somebody that is a team that is harder left, and you get much more issuance and you get even more spending?
It could be, and the way the polls look, it could be very fragmented. You've got a lot of support coming on the far right as well. So you could have a far left come in, but a real minority government with an extreme far right on the other side of things. So politics is a bigger risk than normal because there's more uncertainty than normal. Governments don't last as long as you'd expect. And the problem with populism is everything sounds great, and then it's a short-term fix for a long-term problem, and you never address the long-term problems, and that's why the populations of the Western democracies are always frustrated that nothing fixes the long-term issues. It's basically a sugar rush for short-term fixes, and long-term problems always stay.
And sugar crash that comes after it.
That's how it goes,
It's always fun.
Well, speaking of sugar crash, let's talk about the tech space here, because they really took the brunt of the hit in yesterday's trade. A 1.7% plunge that we saw on the S&P 500, starting to see elements of that in today's trade as well with the likes of ASML and other tech names here on this side of the Atlantic. Just walk us through the logic of that. If we're worried about all these worries, we're worried about a slowdown. Well, growth stocks are supposed to be the winners of this.
And we think it is going to be a scenario where there are going to be winners. There is going to be growth, but everyone was priced as a winner. And we're keeping some of the long positions we have in tech that I still like. We own Alphabet. We own Apple. We started shorting Oracle at the beginning of this week. That's a stock that's at 50 to 60 times forward earnings. The stocks I own are in the 20 times earnings. So if they both win, one stock's pricing maybe a small win, the other one's pricing a huge win. So I've been shorting some of the frothier elements of tech. We started shorting Riot yesterday as well, and Supermicro Computers. So stocks that were priced for incredible growth that they may not achieve are the stocks that have rolled over, and I think there's still further downside there. Some of the great companies that are slightly expensive, I'm sticking with because I do think they grow their way into the multiples.
Riot's been smashed over the last few days, so your timing's pretty interesting. Are you more confident putting shorts on?
Yes, I am. So that's what I've been trying to do. Recently, we've been selling a lot of consumer stocks throughout the summer, and it's worked really well. Like companies like Nike, we closed our short on Monday, and that was a stock that could be impacted by tariffs, by the consumer, and we've moved it into the frothier elements of the no earnings and the low earnings.
So is this
type
market
tech.
getting easier to understand?
Well, Recently, yes, things are behaving as you'd expect. Whenever your positions are rewarded, you think things are rational. Whenever your positions don't work, you think it's irrational. But for me, things make sense again right now, that you're not just seeing everything that says I'm spending on AI, therefore my market cap goes up by 4 times what I spent. You are seeing a little more discerning market where I prefer that kind of market.
How do you feel about NVIDIA?
NVIDIA I still own. It's the 3rd biggest weight in my portfolio.
Yeah.
But the perverse thing with me is I've got a 5% limit on my portfolio, so I'm underweight versus the MSCI world weight. I think earnings are going to be strong. I think guidance is going to be strong. I wouldn't be too worried about going into NVIDIA earnings because all the hyperscalers aren't showing any signs of slowing down.
They're not, but you are seeing it on the hyperscalers. You're seeing it in some of NVIDIA's peers. You're seeing it in AMD. You're seeing it in TSMC. You're seeing these big promises with some of the kind of jitters underneath the hood. So isn't there a question here of deliverability?
There is. People are clamoring for NVIDIA chips. AMD is trying to get the pieces that NVIDIA can't fill. So I do think they have this strong position that continues. In my most flexible portfolios, I don't own NVIDIA anymore. I'm short put options at 170 on it. So it's a stock that I'd like to own a little bit cheaper. And I collect that premium. And if there is that market sell-off, it creates a buying discipline for me.
The whole debate, though, is about how long an NVIDIA chip lasts.
Yeah.
Is it 2 years? Is it 4 years? Is it 6 years? What do you think about this whole depreciation debate?
Yeah, it's a big debate. As long as they keep innovating as well, the shorter turn over time, if they replace it with a higher chip.
That's bad for the people that are buying it because they're depreciating.
It is.
These chips get cheaper.
Yes, and
or less valuable.
NVIDIA's exerting the strength they have from a near monopolistic position and what they've carved out. So it's something that NVIDIA is profiting from and impacting the clients of NVIDIA, which eventually it's going to create, you're inviting competition, but right now...
But those are the people that buy the stock, they buy the chips, and if they're having problems, then...
That's true, yeah. You don't want to create too many problems for your customers, I suppose.
So you're still looking at individual tech stocks. Walk us through some of the other sectors that are looking good. Is it really just the company that talks about AI or the company that wins? What else are you liking right now?
So we're underweight tech, actually. In my long side of my portfolio, we're 5% underweight tech. So it's the biggest sector exposure, but it's underweight versus a benchmark weight. We've added oil in September. Repsol is a new stock we added. Actually, it's in the news again today. But it's a stock that's still cheap. I was probably a bit too pessimistic on the outlook for oil prices based on what Trump talked about on deregulation and maybe a slowing macro backdrop. Macro backdrop hasn't slowed as much. Demand for oil hasn't slowed as much. And it's something that, oil still looks good to me. It's still got a geopolitical hedge. We've seen refinery disruptions happening in Russia as well. That's something that you don't think about all the time, but it is incrementally getting rid of supply on the market, and anyone who has supply that's undisrupted is benefiting from that pricing power.
It sounds like you're not really worried about supply gluts at all when it comes to the oil space.
I was, and I'm less worried now, Demand has been a bit stronger than I thought, and supply hasn't grown as much as I thought it would, and it's OPEC's increasing production, but not dramatically. It is still that scenario where demand's growing in line with supply, and that's pretty healthy.
But we're talking about yes, OPEC has kind of their foot on the pedal for that point. But on the other hand, you're talking about all this narrative coming out of the States in terms of mergers, deregulation, affordability, et cetera. That to me, and we talked about this earlier, that screams to me as Trump wants prices lower.
That's definitely what he wants, and that was one of the reasons I was hesitant to own oil coming into the year, and I've reassessed, and we've added Repsol in September. It's a 3.8% weight versus a 3.6% weight in the benchmark. So it's stocks like that we've been adding, and sticking with great companies that are trading at reasonable multiples, I think, is a winning strategy. Hedging some of the risks that come from that by shorting companies that are trading at extreme multiples and are more hope than very clear cash flows right now. Oracle, negative cash flows right now.
Does it when you talk about those multiples, do those multiples, those very high multiples, require Fed rate cuts? And if those rate
100%. If the Fed doesn't cut, the thesis is maybe it's a correction and maybe a bear market, because I think another December cut comes. I think Powell talks very hawkishly in the market. Just covers their ears. Don't listen to it, because we know a new Fed chairman's coming in who's applying for the job saying, I'm going to cut towards 1% interest rates. That's what the market is partially pricing, and that's how you apply for the job.
Do you believe that thesis?
Yeah.
Well, I think that's, if Trump's appointing a Fed chairman, it's going to be the most uber dove he can find.
So that support, but that argument continues to support multiples going forward.
Definitely, It's I think Powell's going to talk very hawkishly, but still cut, and then after that, the market's going to ignore all the hawkish rhetoric.
If he doesn't cut in December,
Well, that means something's probably happened. Either inflation surprise to the upside, or there's been further strength in the job market. But I do think the December cut comes. He'll try to present it as a hawkish cut.
It's 2-1, isn't it?
Yeah, Guy and I are
we're keeping score this morning in terms of our guests.
Guy said hold, I said cut, and
guess the 2-1.
And I think I'm winning. Just saying. Patrick, very quickly, if I could just quickly ask, if we're talking about cuts though coming in, the entire thesis of a hold is that exacerbates inflation risk. Should this market be pricing in inflation risk more seriously?
The market is completely complacent on inflation. It's just totally mispriced. For the next decade, inflation swaps are 2.2 to 2.3%. I don't see many scenarios at all where Western politics allow inflation to be that. Trump's whole plan is to create nominal growth to fix the debt to GDP ratio. He's not going to get real growth that's doing it. It's going to be the inflation that does the heavy lifting there. So populist policies, interest rates that are cut far too low, that fuels inflationary fires, just completely mispriced for the next decade.
And the market's just going to digest it all.
Well, it's going to lead to a very strong steepening. Tips are massively going to outperform conventionals. Index links are going to outperform gilts that you talked about rising today. Inflation is completely mispriced. There's so many forces going to push prices up. Western debt and deficits don't work unless you have inflation.
And stocks have to go higher in that kind of environment.
If you do get the Fed cutting aggressively, you probably do get a melt up in stock valuations. Long term, you see a real multiple compression. So probably the end of this quarter, beginning of next year, I do think stocks grind higher. And then you start to see multiples come down, and companies that are producing real cash flows wins. Companies that aren't producing them in the near term really get punished because you can't buy future cash flows when you're discounting them at a high rate.
Great to see you. Fascinating conversation. Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Lots going on. OK, let's take a look at what's happening at the Core 6 this morning and figure out what the picture looks like. There's some really interesting names out there that are certainly under significant pressure. ASML is under pressure, as you can see, to the tune of nearly, 2%. We're kind of moving in that direction. Not quite yet, but moving in that direction. Defence stocks, interestingly enough, are down, despite the fact that the Germans actually green-lit some fairly significant defence spending last night. Luxury, though, is on the front foot. Siemens Energy is up. Chloe Melly's got all the details.
Good morning, Guy. Yeah, very good morning for Siemens Energy. It is up 10% after raising its medium-term outlook thanks to really strong demand for gas turbines and also for data center equipment. So that is a company that is really a big beneficiary of this data center build-out, and we can see that reflected in that higher medium-term outlook. It also said that the restructuring process at its wind turbine unit was progressing quite well. So all of that is very positive, and it's being taken quite well by the market this morning, up 10.3% right now. Moving on to UK banks, and we have got some weakness across the board as part of this broader sell UK trade that we've seen as reports are coming through that Rachel Reeves is considering making a complete U-turn on some of the budget proposals. The budget is coming in just a couple of weeks, and she is reportedly considering abandoning some of the measures that were floated before and that had been digested by the market. And so we could see that reflected in some weakness, in particular for Lloyds and Barclays, which are down above them more than 3% each. Moving on to Alstom, which is the maker of high-speed trains. It hiked its guidance for sales, and also its cash outflow was lower than expected, and that was being received really well by the market this morning. We are up 5% for that company. And finally, let's end on another positive move with Bechtel, which is a maker and retailer of personal computers and office supplies. And there, the profit came in way ahead of estimates. And so they're very positive, very strong earnings. And we can see that in a very positive, very high positive movement here, we are up almost 15% for that company.
Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. Let's talk a little bit about the UK bond market. She hit it from the bank story. The bond market also feeling the pain.
This is a huge move in UK gilts this morning. The market is clearly very nervous. And you wonder kind of how far down the road we're extrapolating. This feels like it's more than just simply Rachel Reeves tearing up her budget because of internal political dispute. This is the market signalling its serious concern about, A, the need to get the fiscal house in order, but the fears about what is happening politically within the Labour Party as well, and how tenable Rachel Reeves and Keir Starmer's positions ultimately are.
I'm just very quickly going to look at cable here. 131 and dropping as we speak. So I feel like that pain. And it's the only thing, by the way, keeping up the dollar. Everything else against the dollar is
essentially yields are going higher and the pound is dropping.
Yeah.
So this isn't this is an interest rate differential story here.
No,
this is a fear about the UK.
This is a sell UK trade.
Yeah, precisely. We've got a sell UK trade. The FTSE's down. You've got the pound down. You've got gilts under significant pressure. Yields spiking sharply higher. There's a lot going on here, and it's all negative.
Well, we're going to continue this coverage. We're going to walk us through some of the scenarios here. We've been debating it all morning about how this all shows up. We'll talk about UK assets more coming up. But we're also going to stick to the earnings story with Richemont sales climbing for the first half, signaling a possible rebound for the luxury sector, specifically in China. We saw the story yesterday as well. We'll dive into the details. More on that next. This is Bloomberg. Welcome back to the opening trade. 20 minutes into today's session, and the markets are selling off across the board. You're seeing a lot of pain right here in the FTSE 100, down about 1%. We'll dive into the UK story briefly, but it's not looking that rosy anywhere else either. Perhaps taking cue from the sell-off we saw over in the States in yesterday's session. One place where we are seeing some green on the screen is in the luxury space. Richemont coming out with their earnings this morning. Those shares bopping by about 8%. I guess I said bopping and not popping because they're doing both. The Richemont sales have risen on better than expected demand in the Americas and the region, including China. A positive sign that the luxury industry may just be coming back from a slump. All over this is our Paris-based luxury reporter, Angelina Raskoway, and she joins us now. Angelina, just walk us through these details. Is this a fluke when it comes to the luxury space?
Hi there. Indeed, basically, Richemont is going from strength to strength. This year, it's been a very difficult year for luxury groups. There's been a downturn, in China. Consumers in China have not been buying. There are worries there. The U.S., there was worries about the U.S. tariffs. And actually, what we saw with Richemont is that they weathered that downturn very well. The shares year to date are up, I think, by more than probably today 20%. Today, as you said, they're up 8%, and that's because they're very exposed to hard luxury, to Cartier, to Van Cleef, and actually, in these times of uncertainty, consumers deem this category as probably more resilient and as a better store of value compared to pricey ready-to-wear or pricey handbags. So it's been very positive overall, across all regions as well.
Angela, tell me about the tariff story, and what does Richemont think about it? Richemont, the big CEOs of the big luxury companies have had a big impact on this tariff story over the last few weeks, and I'm really curious to get kind of their take on what is happening here. So what did they have to say?
Absolutely. And what was interesting with Richemont is actually in the second quarter, the Americas was actually the strongest region. They grew 20%. So despite the announcement of these tariffs of 39%. So actually Switzerland was slapped with a 39% duty from the U.S. administration. That was the highest tariffs on any developed country. But in recent weeks, there's been talks. As you say, a few top executives and billionaires of Switzerland, they went to the Oval Office, they met with Trump, they're trying to make a deal. And it sounds like we're on the right track. It sounds like Switzerland could now have a tariff of about 15%, which would be on a par with the rest of the EU. And that would be very helpful. However, what we saw with Richemont is that they have a lot of pricing power. Johann Rupert, the chairman of Richemont, has said that they haven't applied, the greedflation. Other brands following the post-pandemic, they got ahead of themselves, they increased prices by a lot, and actually Richemont was very reasonable. And so they still have that margin of maneuver, and that's what we saw in the results in the Americas, up 20%, which is pretty staggering.
It's amazing, isn't it? Angelina, thank you very much indeed for updating us. Angelina Raskoway joining us out of Paris on what's happening with the luxury space. Let's bring it back to what is happening in the UK. Gilts are getting battered this morning. This on reports that the Chancellor, Rachel Reeves, is dropping plans to raise income tax. There were only plans, but apparently they've already been dropped. Anyway, the budget is coming really, really soon. Got concerns over what is happening in the UK finances. You've got concerns about the politics. Let's try and figure out what the message the market is sending this morning. Bloomberg Markets Today blog editor Sam Unstead joining us around the table. If you're sitting at the Treasury this morning and you're looking at the gilt market, what signal are you taking?
I think the big signal you're taking is that they don't want the politics to win. You know, so when you're trying to price in, there's a lot of uncertainty about the budget anyway, but one of the key things that you have to do is this trade-off between getting a more sustainable fiscal picture that takes this question of fiscal headroom off the table a little bit more, that it's not something we're basically talking about almost every day in between the 365 days between budgets. Raising income taxes does that. Whether there was any kind of firm plan to do that or not, don't know, but by the looks of it, it's gone. And that would indicate that the politically toxic side of it has won out. And what that effectively raises the possibility of is that you get another budget very similar to last year's one, where there's a lot of tinkering around the edges, where there's a pretty narrow amount of fiscal headroom that can get wiped out pretty easily. And then over the course of last year, we've had consistently, sort of every 3 or 4 months really, a little blow up in gilt markets, often driven by not a huge amount. And that kind of febrile atmosphere underneath it, a lot of that is driven because there's this question almost every day about fiscal headroom, about the fiscal picture in the UK. And if you don't do these big taxes, then that's going to rain.
So the smorgasbord, as Alex Littman called it, is not,
Sure.
it's not what markets want. So let me just make this super simple and super clear, maybe a little reductive. Gilt investors, gilt bulls want income taxes.
What they want is to take that question that's effectively asked as someone who's reporting on the UK market, every single day for basically the last 360 odd days, where's the fiscal headroom? How much fiscal headroom does she have? Over and over and over again. The income taxes takes that off of the table, and that just allows a little bit of space.
But are we moving beyond that? Are we now moving beyond where the politics, her position becomes untenable, and the fear is that we go further left, and you end up with more issuance and even more spending, and the gilt market will be terrified by that.
Yeah, and actually that's a good point, because this comes in a week when you've had this extra little blow up around West Streeting and these sort of questions of whether Starmer's position is good. Reeves' position sort of gets questioned again every couple of months. There's kind of questions coming in about that. That lack of stability is a key problem for gilts and has been a key problem for UK markets over the course of the last year. And the pound as well. The pound has become extra volatile. Will probably continue to do that, over the course of the next couple of weeks.
Sam, interesting run to the budget now, isn't it? Wow. OK, we're going to be busy. Sam Unstead from our Bloomberg Markets Today blog joining us. Remember, we've got some great specials around that budget coming up in a couple of weeks' time. What are we going to be doing next? The CEO of Vinted is going to be joining us. Thomas Plantenga is going to be joining us. We'll get a take on what is happening at that business. Revenue growth is extraordinary. Anyway, we'll come back to that in just a moment. This is Bloomberg.
Welcome back to the opening trade. 30 minutes into today's session. Happy Friday. It's not exactly a rosy one. You're seeing a sell-off across the board. A little bit of catch-up from what you saw in the States yesterday. 1.7% sell-off in the S&P 500. Similar story here in Europe. The FTSE 100, though, Guy, is where the pain is. Walk us through what you're seeing.
It's pretty broad-based, the pain, I have to say, this morning. Take a look at this. Stock 600, 70 up, 69 up. 523 stocks are lower this morning. 523 out of the stock 600. And look at this, volume is high as well. You're getting some real churn within this market. Volume's been actually reasonably anemic throughout this week. Been pretty much at the average. I don't say anemic. It's been average this week. Now we're getting a big spike higher in terms of the volume story. I just want to show you what's happening in the UK, because the UK narrative is the one that is dominating here in Europe this morning. FTSE 100, international but affected by UK sentiment, is down by 1% this morning. The UK 10-year yield, 10 basis point move to the upside. That is huge. There's a really big reaction in the gilt market this morning to the FT report, suggesting that maybe the whole idea of raising income taxes is out the window. Look at sterling. It is down. Now, normally you'd think, higher yields, actually sterling would do better, but it's not. And that is fascinating as well. Normally you think actually the pound is lower and the FTSE 100 should be higher. Translated earnings, it's not. It's a big kind of move in terms of what we're seeing around UK assets this morning, Kriti, and it's not looking good.
It's not looking good. Let's go to the heart of it. It's our top story and some of the things you need to know this morning. UK Prime Minister Keir Starmer and Chancellor Rachel Reeves reportedly scrapping a plan to raise income tax rates and a slew of other levies. That's what's moving the markets this morning. First reported in the Financial Times, sources now telling Bloomberg the move comes over a potential backlash from voters and labor lawmakers. The Chancellor, of course, still needs to fill a budget hole of as much as 35 billion pounds. Let's go to another part of the world here. China's economic activity cooled more than expected at the start of the fourth quarter. Beijing reported an unprecedented slump in fixed asset investment, which shrank by 1.7% in the first 10 months of 2025, while the National Bureau of Statistics says industrial production saw its smallest gain of the year at just under 5%. And U.S. President Donald Trump is readying substantial tariff cuts designed to address high food prices. The administration has unveiled new trade deals with Latin American countries as they seek to address voter concerns over the cost of goods. The push comes after key electoral victories for Democrats last week in state and local races where they ran on the platform of affordability. Guy.
Okay, let's talk about what is happening with the consumer from another angle. The online second-hand marketplace Vinted is expected to bring in over €1 billion in top line in revenue this year and 10 billion in gross merchandise value. Just in terms of that revenue top line, that's up circa 25% on a year earlier, which implies some significant growth that we are seeing here. Thomas Plantenha joins us now. He is the company's CEO. Thomas, thank you very much indeed for joining us, and I hope I got the pronunciation right there. We were practicing, you and me, during the break.
That
to make
is,
sure it happened. Great to have you. Great. It was okay, wasn't it?
Very good, very good. Best in non-native Dutch has ever done.
Okay, I'll take that as a tick in the box this morning. Let's talk about the numbers. Look, you're up by 25% on the top line. Where is that growth coming from? What's the message that a 25% top line increase tells us about what is happening at Vinted?
Yeah, so it's actually a plan coming together that we set out many years before. We've built 3 different businesses, which is the marketplace business, the shipping business, and the Vinted Pay business. And we see that all these 3 vectors we are now accelerating. So the marketplace has been accelerating because Germany has been doing very well. We fixed that market as one of our biggest growth drivers right now. And at the same time, we've expanded into new categories. And then with Vinted Go, our shipping solution, we've expanded to the 5th market, and we see that the other markets are really progressing very well as well. And Vinted Pay, our payment solution, has been scaling onto our members in the last months, which also helps us to drive costs down and bring revenue up.
In terms of the move into the United States, what happens with that? Does that turbocharge the kind of growth we're seeing once you make that stick? What does it look like? Will it stick?
So obviously the US is a massive market, and we've been very successfully now in Europe, and we've built it for like 9 years in a row to really build that foundation to be able to get good economics, steep growth curves, and penetrate that secondhand market to a completely new level. And with that knowledge, we now see that the US market is actually very immature. So all the players that are there are kind of struggling, and the penetration level of secondhand is actually very low. So for us, that is a huge opportunity. Yet every market and every continent is different. So we started now, as of Monday, we will connect London with New York. So finally, New Yorkers will have a very tasteful European fashion that they can buy secondhand. And we'll start testing. So we have a very analytical, cost-conscious approach where we have all kinds of phases we go through to test and see if the market is ready, to see if in the next year we'll lean in with bigger investments to develop this market. But it's a huge opportunity, and we're carefully testing as we are launching and testing every year multiple markets. So let's see how that goes, but definitely a big opportunity if that plays out well for us.
Kriti, do you agree with him? Better European fashion?
I mean, I hate to say it. I think he's right. I think the Europeans have the edge on the Americans when it comes to fashion. But, you know, Europe versus New York, I don't know. But, Thomas, I'm glad you brought up New York. As a New Yorker myself, I'm going to claim that title. There's already a player in New York, a pretty big one, on the Upper East Side. It's called The RealReal. They're expanding across the board when it comes to luxury resale specifically. What is The RealReal not doing that Vinted can?
So the RealReal is a great example of a good company that is doing secondhand, and they're doing that in luxury. And they're very focused on, let's say, they have their shops, brick and mortar, and bringing that quality and authentication that people love in New York. And I think they're really speaking well to a certain segment. But what Vinted does is that we're building a proposition that makes secondhand accessible for anybody. Any type of secondhand good, whether it's regular fashion or electronics, adapters, mobile phones. we can bring anything to you at a very low price with very high sell-through rates. So we're as a platform that is built for anybody, not just for luxury. And that gives the opportunity for many people to join and practically be this mass market proposition that enables people to buy and sell things. So what we've seen in Europe is that there were many players in all the different countries, all kinds of luxury players, but also low value players in many different forms, more the ones who are authenticating, more the ones who have shops, all kinds of different players. What we've seen every time we enter a market, we completely grow the market. So the other players stay in that market in the same way and continue to grow, but we completely grow the total market because the total addressable market grows, because we bring a proposition that has way lower cost and much more value than what the other propositions are.
Well, Thomas, as part of your expansion to the United States, I think what's really interesting, what seems to be the edge that you're bringing about, is that connection to the UK market. So it's ultimately a UK seller can find a American customer and vice versa. Yeah. But my question to you is, how does that affect your profitability, your margins? Because anyone who's shipped anything into the UK has to pay a massive fee on it. And now you're starting to see the same policies in the States as well. Don't you get hit on the shipping?
Yeah, of course. So that's not a long-term solution. Yet it is a part of a longer-term strategy that works very well for us in many, many different countries. So we've always used well-working countries to, on the back of that, launch new countries. So you bring the liquidity of that well-working country, for example, France, into the Belgian market, kickstart that market, and then let that market on itself later on thrive and have perfect cost and profitability margins. So it is a kickstart strategy that has worked for us in 26 other markets that we're now applying, let's say, with the New York, London connection. So yeah, obviously we're not gonna, in the future, continue to subsidize US, UK shipping.
You're in Vilnius, you're in Lithuania, you're the country's first kind of major unicorn. And I'm wondering what exposure in the United States is going to do to change the nature of people's perceptions of the business. US investors are going to take a serious look at you guys. And I'm just kind of wondering if the move into the States has other implications as well in terms of where you see the business going, not in terms of kind of where you're going to sell, but where the business itself is going. Does this, if you do well in the States, does it make an IPO more likely? Does it make a US IPO more likely? How does the exposure to the US change Vinted?
So I think it's a fundamental change if a market like the US works, because if you have Europe and you have the US, then you can really be a global player. And the sad reality is that in Europe, we've not built many global players. Spotify has surpassed 100 billion, but that's the only company that did that was started in the last 30 or 50 years. While in the US, they've built $7 trillion companies. And if we want to thrive as a society in Europe, we need to build massive companies that contribute well to the tax coffins of our countries and Europe. So for us, it is very important to see if we can go on a scale that is beyond Europe, because then we can be truly a global player, can truly make second-hand first choice worldwide. And that obviously has impact on how investors look at us. Because as you expand into a new continent, the TAM that you can possibly capture it's much bigger, and therefore the returns on future investments will be better. So that is definitely a big part. We've very much chosen to carefully go country by country in Europe to build a strong base, to then go outside of Europe also carefully. So we're making careful steps now. We're testing in the US as for Monday, and we'll see how things go. Hopefully we can make that change, because I really believe Europe needs more global tech companies.
Thomas, let's take a 30,000-foot view of this, if we can. We've talked a lot about your business, your ambitions, your expansions. Talk to us about what you're seeing in the data, in the customers that you serve. What are they responding to? What brands are working? What kind of sales are you seeing? What are people gravitating to in the various markets that you're seeing? And are they different? Or is every kind of global consumer kind of veering towards the same thing?
Yeah, so around fashion, especially, and we have a lot of fashion on our platform, there's a lot of smoke and mirrors and like brand thinking that people think that is important. Yet all across the world, across all people, we see the same trend. People are very cost sensitive, and they're very much look forward to make some money out of the clothing that they don't use anymore. So the monetary driver is very big for people. Then a second thing that is incredibly important is that the ease of use is very high. So that means selling very quickly, being able to transact very easily, and when all that happens, that it's all happening safely. So yes, fashion trends are different in every different country and there are all kind of particular trends, but the fundamentals of our business stay exactly the same. And our strategy is exactly around these fundamentals. So since the beginning, I started running this company, we focus on cost efficiency and adding value to our users. So we want to be the most cost efficient and we want to be the most reliable to our users. And that is what we focus on, and that has driven the success of the second-hand market for us.
All right. The Vinted Group CEO, Thomas, I got to do it. Plantegna, I'm sorry. I can't even attempt it. It was lovely having you. Thank you so much on the program. Coming up, we have one more conversation with the C-suite. Anders Malmström, CFO over at Swiss Re, joins us to discuss the reinsurer's earnings next.
Okay, let's talk about rockets. Blue Origin finally launching New Glenn. It's the second launch. The key thing here was they actually brought the bulk of the spacecraft down as well and landed it as well. So this is a reusable spacecraft now, like SpaceX. The landing in the Atlantic was actually the key moment. Jeff Bezos was there. Remember, he is the guy that backs this company. They're trying to break the grip that SpaceX currently has. It was a huge moment. This is what it sounded like.
10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Lift off detected. Tense motion.
Welcome back to the opening trade. About 46 minutes, we'll call 47 minutes into today's session. Red across the screen. When you look at the pain points here, it feels like the sell-off is fairly broad-based, but your massive underperformer this morning is the FTSE 100. Lots going on in the UK political space that is spooking UK assets from equities to bonds to the currency. We'll dive into that story in just a moment. In the meantime, of course, we are still in the middle of earnings season. We should go to one company we have our eye on, and that is Swiss Re. Those shares dropping this morning by about 3%, despite them confirming their full-year profit outlook. The results in the first 9 months actually benefited from fewer natural disaster claims. They did, however, see some lower profit when it came to their life and health businesses. Let's get a quick check on this company here and bring in the CFO of Swiss Re, Anders Malmström, joins the program. Anders, a pleasure to have you. Thank you so much for your time this morning. You're reading the analyst commentary, or I'm reading the analyst commentary off the back of this earnings report, and there's some questions here about where the growth strategy actually is. Can you just walk us through these numbers and maybe what you think these markets are responding to?
So good morning, and thanks for having me. It's always a pleasure to be here and walk you through the results. Overall, we're very happy with the results. I think we achieved a net income result of $4 billion for the first 9 months. This puts us in a very good position for the full year target. Remember, the full year target is $4.4 billion or to be above that. So we're well on track of that. Overall, we got great support from the property and casualty business units. Very clearly, they benefited from the benign Nat Cat seasons Nat Cat events or non-events that we had in Q2 and Q3. But I want to remind everybody, we had a very severe Q1 with the California wildfires, but also with events in Australia. The third
good morning.
business unit, Life and Health 3.
Yeah,
I just want to finish
on
Life and Health 3.
That's what I want to talk about.
That was part of your questions. Okay, very good. Thank you so much. So Life and Health 3, overall, a solid performance with $1.1 billion. But as we mentioned also beforehand, we saw some smaller portfolios. We saw negative performance. So we took actions to make sure that we put this business unit in a good position for the future. So that's where the underperformance in Life and Health is coming from.
Why do you have to withdraw guidance for that Life and Health business, though? What is it that when do we get guidance for that sector? When do you think you're going to be confident enough in the outlook to give us some guidance on that space?
So maybe just overall, look, I think when we started the year, we have two objectives. One is to meet our financial targets, and second, to build resilience to Swiss Re. Overall, for the group, we're meeting and we will beat the target for the full year, as I mentioned that before. But at the same time, we also want to build resilience. On Life and Health 3, we decided to do that now because it was underperforming. But also want to mention the large portfolios, particularly the US mortality is performing very well, is performing in line with expectations.
Anders, I want to come back to some comments that you have made previously, basically confirming that Swiss Re had negligible exposure when it comes to First Brands and Tricolor. But can you just give us a little bit more insight of what that means and where in your business you had that exposure?
Yeah, so just to clarify, we have no material exposure to these two papers.
But you had some exposure. Where was it?
Yeah, we have a very small exposure on the investment side, but at the very high end, so we don't expect any impact there.
Yep.
And then, yeah, that's it. Yeah.
Anders, how much of the portfolio though is in private assets right now? How much exposure do you have to private markets?
So private markets are a good diversifier for the investment portfolio. Private markets also give us an illiquidity premium that will help the portfolio. Overall, it's less than 6% that we have in private debt. The majority of that is in infrastructure, which matches very well with our business model. We take a very conservative view on the private debt side. It's important we have really good due diligence, but overall I feel very comfortable with the private debt exposure that we have.
Anders, I'm going to switch topics with you in the last kind of few minutes that we have left here. Switzerland very much in the news this week as there's conversations from a geopolitical and tariff perspective between Washington and Bern. We know that you've set up a task force to monitor some of the impacts of that tariff exposure. What have you found? What are you thinking about? What are you hearing about from your colleagues who are engaging with Washington?
So we are monitoring the situation obviously quite well. I think the US for us is a very important market. We're very committed to the US market. For us, it's important, good trade situation I think helps the economy, and if the economy is going well, then I think this is good for society, and this is then also good for the insurance industry.
Anders, great to catch up with you. Thank you very much indeed for all the clarity you've provided this morning. We always appreciate you joining us on the programme. Anders Mellström, the Swiss Re CFO. The Treasury clearly has been watching here in the UK the reaction that we've had to the headlines in the FT this morning in the gilt market, and we're getting some headlines as a result of that coming through. This is basically briefings that are happening at the moment on the back of the moves that we've seen. The headlines basically say the following. The Chancellor Rachel Reeves is still expected to deliver a headroom of 50 to 20 billion. The improved UK forecast, so economic forecasts apparently have been improving enough that she's been able to drop the tax hike story that we've been talking about over the last few days. Now, there's a lot of kind of politics involved in all of this, and the market will make up its own mind. What we have seen, though, is a move that is slightly more positive towards UK assets since those headlines have dropped. Apparently, the latest UK fiscal forecast put the gap at 20 billion. So we talked at the beginning of the show about a 30 billion hole. Apparently, it's only 20 billion. That's still a big hole.
Well, still definitely a big hole. I don't really know what you do with this, though, because it feels like we're going towards right where we started 2 months ago, since the manifesto, or since the speech that she said.
Yeah.
Was that? I can't even remember when that was.
Is she? Yeah, that kind of special. It was only about 10 days ago. But the
feels like months ago.
It feels like definitely feels like longer. But the market's going to look at this and say, is this just internal politics? Is this basically her having to change her plans because of concerns about the manifesto pledge? So the market's going to look through a lot of what we're hearing in terms of the briefings that are clearly going on. Mark Cudmore, our executive editor for Markets Live, joining us now. Mark, again, kind of the UK stuff. Is the UK idiosyncratic here, or is the UK emblematic of what is happening more broadly?
Can it not be both, possibly? I think clearly the UK is idiosyncratic in some way. I mean, they have some ongoing and sustained problems politically with a fiscal hole that I'm not sure how they ever get out of it. So, you know, I think that it's at the forefront of a problem which is probably emblematic globally. There are more and more Western economies that do have growing fiscal holes, that they don't have the will to kind of get out, escape them, and it's kind of a long, slow decline, and the UK is at the forefront of that. This is interesting. I don't know what to take of the latest headlines. You know, I've been off the desk for the past hour, I walked to the studio just as the headlines kind of came on. You know, I thought there was an overreaction initially to the FT story overnight, and now it seems we've entirely erased those moves. My suspicion is that overall into next week, none of this is good. You know, the UK story is not suddenly positive, even though we've kind of changed the narrative on the overnight headlines. It's saying there's a lot of uncertainty out there. The UK is in a tough spot, and I think sterling will remain under pressure overall, even if some of the short-term pressure is alleviated.
Mark, very quickly, what do gilt bulls need to hear? Outside of everything solved and the budget is balanced, what do they need to hear in the run-up to the budget?
Yeah, it's really interesting, actually, Kriti. I think there's a bias to buy gilts here. That, you know, a rate cut, I mean, I'm not sure what the latest pricing is, I must admit, but as of yesterday, the rate cut was about 80% priced for December, and the market kind of really wants there to be a rate cut in December, so it seems like people were biased to buy gilts. It was going to have to be, you know, 24 hours ago, I was thinking it would have to be a shockingly high CPI print next week to kind of not get that cut in December, and therefore we've had a positive backdrop for gilts. In terms of the structural story, though, there's just this big fiscal hole the UK is never going to sustainably solve. They're just putting off problems. So, like, I think gilts are ultimately heading towards a disaster, but I think it's much farther down the line.
So, Mark, what do you watch this weekend? Do you watch the crypto market, which you were talking about this time last week, or do you watch the Australians beat Ireland?
I watch Ireland beat Australia. They're not as bad as you might think. The red card against the All Blacks kind of was deceiving in that game. I think Farrell will have learnt a lot from the Lions tour in the summer. I know Ireland haven't been brilliant. I know Australia have been much better than a year ago, but Ireland should still win this game, even though they weren't brilliant against Japan last week. Much more importantly, though, is Ireland's Irish football team has a chance to go to the World Cup, and we're terrible at football at the moment. This is not like the good team in the 90s when I was growing up. We're useless, but we beat Portugal 2-0 last night before Ronaldo got sent off in frustration that Ireland were outplaying Portugal. So we have a chance of still getting into the playoffs. That is the weekend excitement.
Okay, plus all the other stuff that's on the screen as well. There's an NFL game somewhere as well.
A film festival.
That's important too. There's a lot of rugby this weekend. Fantastic. Anyway, enjoy the weekend. Mark, thank you very much indeed. Lots going on in London. This is Bloomberg.